Hi, thank you all for joining in. We just wait for a couple of more minutes for more participants to join, and we'll start in about 5 minutes. All right, I've been given the go ahead to start. There's something wrong with my video, so please excuse me for this particular webinar. But the topic for today is how do we look at a multi-asset strategy for a volatile year? Let's look at what multi-asset actually means. Like, what do people do in volatile markets, right? It's these doubts that come up. So markets have already moved up. Should I wait or should I wait it out? Second, I think that markets have already corrected. I think I'll wait for more correction to come. Then there's a little bit of FOMO that yes, I think that I don't want to miss something out, so people plunge into it. And then there comes this problem of oh no, I should have waited. My portfolio went down, or oh my God, I missed it. The portfolio went up. I should have participated. And then you start thinking, saying, have I missed the bus? Have I missed taking the right decision? Have I made the right decision? Did I lose out on an opportunity? This is what investors think in a volatile market. And 2025 again is going to be a very volatile year. Markets are going to be very volatile. We have to just accept the fact that it is. We've had a great run for the last 3 years. So naturally, you will face a good amount of volatility. See, when volatility doesn't mean volatility down, for the last 2, 3 years, volatility has been more on the upside, right? So naturally, you would have volatility on the downside as well, right? So what is the result? The result is that there is no investment discipline. The result is that you are always chasing performance, and you know what happens when you chase performance? You usually end up losing more than you're gaining more, right? Your investing is very anxious, which means you're always looking. You don't have your nerves under control, and your particular milestone is missed. For example, let's say you're saving for a particular goal where you want to have that goal for wealth creation. So by doing too many things, right, or trying to do too many things, trying to time it, you're obviously going to miss out on your particular milestone, right? So look at Ray Dalio. What does he say? The most important thing you can have is a good strategic asset allocation mix, right? You look at the other part that's highlighted, a portfolio that does well in different environments. uh, we don't know that whether we are going to win or not, but we just have to make diversified bets, right? Because a portfolio can do well in different scenarios, given that every asset class performs differently in each year. So I think we've there is a quilt, right? We'll look at that, going forward, where it clearly shows which asset class is actually doing, and this is all past data since 2020. I'm not even considering the entire of last year, right? So now is the time to reflect. What is the best investment? Is there such a thing as a bad investment? Why do people think so? Anybody can put a comment on, the chat box. Say, what is a bad investment? What do you consider as a bad investment? Right, what do you consider as a bad investment? Nothing is bad. Somebody has commented saying nothing is bad. Okay. Timing is most important. I disagree that timing is most important. Maybe after the webinar, when we're doing more Q&A, there is a good amount of stat that says majorly where are the returns coming from. It's coming majorly from asset allocation, but we'll get to that. Right. So it's time to reflect. Does performance follow a particular pattern? Right. Can we predict returns? No, we cannot predict returns. Does performance follow a particular pattern? No. Is there such a thing as a bad investment? No. There's no such thing as a best investment, because what is the winner of yesterday will be a loser of today. This is the quilt that I was talking to you about, right? You just see from 2010 to 23, no, not considering 2024, because there's another winner. And I would say if you can guess who the other winner is, kudos to you. But if you look at 2010, 11, and 12, you had one particular set of winners, right? You see gold doing extremely well from a 3.5 year perspective, and then gold does not do well, right? Likewise, you have uh, small cap that is doing well in 14, 15, 16 and 17. But if you see from 18, 19, 20, 21, you see if the starting point of an investor is 2018, then you have a very bad experience all the way up until 2021. Right. So you cannot time, because when you start timing, you're looking at the past data. You're not trying to look at future returns. You're only trying to look back. But this quilt just highlights the fact that you cannot predict who the winner would be, but having a diversified approach is going to help investors out, and making sure that that diversification is not just on the equity part. This is why Neo, this is the philosophy of Neo, right? Where we don't have a cap on any particular asset category. Right? We can go 0 to 100 in any category. Right? Why? Because you don't need to have a cap. So for some cases that within the equity part, some parts of the equity like mid and small, because of valuation, do not make sense for an investor to do. Right. So as money managers, we always see that, okay, from a fundamental standpoint, it's not feasible to pay these sorts of valuation. So it's time to step back. This is why that diversification approach works within a particular category and between asset classes. Right. Because you cannot predict, you cannot time, right? And investors need to have a very stable journey in terms of wealth creation where the volatility is lower, right? So can gold give 0% returns? Now you know that over a long period of time, can gold give 0% return? As a I just showed you that particular category. No, somebody said no. Yes. Okay. Even negative return. But this is from a long-term perspective, and you have to consider long-term to be plus 10 years. Sometimes, yes, of course, I would say that yes, there are periods where things consolidate. So you see between 2012 and 2018, the return is very, very low, right? CAGR of 0%, right? So there is a period in which one particular category does not do well, whereas the other particular category starts doing well, right? So for somebody who is on the Neo portfolio, they will always see that there is a good amount of each asset category or each asset class that's there, and within that particular category, there are good uh, parts of the market that there is no participation in, and there are parts of the market there is very high participation in, right? Because we understand that seeing these types of valuation, you might have a 0% sort of phase that's there, and diversification only allows you for a 0% to avoid this sort of a 0% CAGR scenario, right? So there's no such thing as a good idea or a bad idea in the investment world. It's a good idea at a price, right? So always valuation is the forefront for us to drive in terms of how well we position our entire portfolio, right? So what has been our top three lessons when we run the multi-asset strategy for Neo and Sphere? And Neo is meant for non-resident Indians. Sphere is the other multi-asset strategy which is for Indian residents, right? So did you know that there are 0 years where everything fails? Today we are in a scenario where your gold is at an all-time high, your real estate is at an all-time high, and your equity was at an all-time high, right? So there is no year in which everything fails. So there is one year, at least in any year, there would be one category that shines out, and that's what the quilt is all about. So if you see the quilt, let me just take you back to the quilt, right? You see the quilt, there are periods in which debt has done phenomenally well compared to equity. Right, there are periods in which equity has done well, there are periods in which international has done well. So we wanted to capture the entire thing, the entire part of the asset categories that deliver in specific times of the market, right? So then 50% of the time in the last 14 years, right, all assets have delivered a positive return, right? This was a very interesting point when we saw that at least in 7 years, right, all the assets, and this is one of the years where all the assets have delivered a positive return, though it might not be high, but I'm just talking about from a positive sense. So 50%, so 7 years, right? At least in 7 years of the time, all the asset classes have been giving you positive returns, right? Now, losers can become winners and winners can become losers. This is the most important lesson that we have learned, that when you look at it from a long term perspective, you can't say long term and only stick to it. The idea of long term for us is that we will always hunt for opportunities to invest in. It's not that we would only stick to one particular idea or only stick to one particular category or asset class to say that this is long term. No, long term when it comes to managing money and wealth creation only has to do with finding opportunities and investing at them at the right valuation, knowing the risks that are currently involved with the company and in the market. Right now, how do you do well during different environments? Right, so there are domestic equities that we use for wealth creation. There is foreign equities that we use, to have a good diversification in terms of geography. There is short-term debt to offer portfolio stability. There's long-term debt for yield enhancement that we use. See, the options are completely available to us, right? So there is precious metals that we use as a store of value, and precious metals for Neo as a percentage of our entire portfolio is very high. So unlike that of a or a multi-asset mutual fund, where they have a specific cap in terms of net assets to equity, and we don't have that particular cap. It goes 0 to 100. Right. So precious metals and commodities, I would basket in one basket. Right. So all these options for us are available to invest in. Now, go beating volatility with maths, and this is some good amount of math. So correlation is positive when the values increase together, but correlation is negative when the value decreases as the other one increases. So just have this in mind. I'm sure that all of you are aware of, how correlation works, but just have this. If it's positive, then they increase together. If it's negative, then one of it decreases and the other one increases. So you look at the diversification benefits that you get when you have other asset classes as well as global. Right. So the diversification benefits are huge. So hence the volatility also is lower. Is lower. So if you see this map, it just shows that there is a good amount of comfort when it comes to taking that diversification call for other asset classes. Now, let's look at the diversification. So what are investors worried about today? They're worried about inflation. They're worried about the war. They are worried about recessions in the US. They are worried about today, yes, the worry is that markets are falling, but rising markets also are a worry because you don't know when that party is going to end. It just, I think I'm having a little bit of a voice issue. Just hold on. Can somebody just give me a thumbs up saying that everything is okay, everything is audible? Okay, all right. Thank you so much. Yeah. So these are things that investors are worried about today. Rising inflation. There are talks of war. We are right at the brink of a slowdown. It looks like it, but it's very edgy. Then usually election outcomes. Now after seeing Trump, how the sentiment has changed. But reality is still yet to sort of come in. But sentiments keep changing. Rising markets always give bullish sentiments, and investors really need a reality check after that. And of course, market volatility today, in the entire of the month, you have many small caps that have halved from their highs. This month alone, they have seen very bad movements coming in, a lot of volatility coming in, and a lot of investors are worried about it. So how do you turn worries into opportunities, right? So when we look at domestic equities, we look at monopoly businesses where the fundamentals do show strong growth, where their balance sheets are strong, and where we can have a wider participation in terms of investing in them for our investors, which is majorly more large cap oriented. So a lot of opportunity that's comes in on that side. Then on the foreign equity part, these are usually high contrarian bets that offer high value opportunities to investors. This can be whatever we have access to, which is more on the Asia specific side, more on US. Right now, we don't have anything on the Europe side, but yes, we do have opportunities to invest there. Right, short term and long term debt. Here we use more from yield management. Here we get a lot of mark to market gains. But right now, our allocation towards debt has been low. But the philosophy for investing on the debt side is today India yield is somewhere around 7 odd %. And as India grows, that yield also should soften, and that provides an opportunity for us to invest in to make up that gain in terms of appreciation and to get a good amount of yield. Right. Then you have precious metals and commodities. This is a hedge against inflation and currency, which we have an option to invest in. This is what we do on the Neo side, where we use precious metals and commodities to protect the portfolio from high volatility against currency depreciation and in terms of high inflation. Right. So there's too much of geopolitics. There are now with the cut that's coming, whether there is a requirement for further cut or a rise. To avoid all these sorts of scenarios, you have precious metals like gold, silver, and today gold is at an all-time high in the US terms. Right. So how do you make asset allocation work for you? Be very conscious of valuations. So we are very conscious of valuations. We are contrarian. Our portfolio is completely contrarian in nature. We are staying away from the crowd, and we slowly build up our positions, which means we take a very staggered approach in terms of buying into new themes and buying into new ideas, which I can cover, in the further slides on how we are able to identify themes and how we are sizing up our positions. Right, a little bit of everything works. Yes, that's why we have kept that cap. We have not kept that cap of say 40 or 50% in equity or 20% in debt. We have kept it as it can be 0 to 100. It can go uh, anywhere. And so let's look at how we are actually managing new. So like I said, no cap. It's a top down and a bottom up research on all asset classes, and it's concentrated across themes with a market leadership bias. This is where that part of strong growth plus wider participation comes in, because here we are able to participate with market leaders. Right. So when we look at a thematic idea, now let's say for example we take a thematic idea of financial services in India and digitization, right? So financialization of Indian household as a theme has a long way and a long runway to go. So how do we look at it? We look at it more from a top down and a bottom up approach. So when we look at it from a top down approach, we then break it up into an active and a passive strategy, where a passive strategy is majorly ETFs and mutual funds, where it's more sectoral driven and thematic driven. If there's a global, then yes, global ETF can also come into that. And an active strategy is basically your direct equity, where we just take a direct exposure towards that particular business. We are able to take that with debt products as well. So passive is going to be a complement of the active, right? So you will always have a basket. We take a basket approach. So when we look at financialization, we'll say, okay, if banks are have to be a major position in the portfolio, how do we take that sort of banking approach? Should it be more public sector? Should it be more private sector? Right. Same case for infrastructure. If you're bullish on the entire infrastructure space in India, what do we need to be bullish on? Can we take the entire basket? Right. So passive and active go hand in hand, where the strategy complements each other like a basket. Of course, then you have bottom up where it's completely active, where these are all high conviction bets on direct equity businesses, right? But let's look at how we are able to take that think tank into yielding results. So when we take a top down approach like a financialization theme, we say, okay, we want to go more towards public banking, right? And at a time when public sector banking was extremely cheap, rather than sticking our neck out for one particular type of business or one particular bank, you can take the entire pack. So that option was very much available to us, right? Hence a complementary strategy, right? Where you have private banking and you have public banking, but an overweight more towards the public side, right? So the buying took a long time. This is where we say, having that staggered approach where we don't deploy everything on day one. Say you give us that entire money on day one. It takes at least 3 to 4 months for us to deploy that entire money. But in this case, we have been buying all the way for 1.5 years. And after prices start to soar up is when we started to see a lot of exit when it came to this particular idea, right? So understand this. When we figure out what we need to buy into, it takes we take a good amount of time to scale our positions up. Since we have no cap, we can scale it to a very high level. It takes some bit of time for us to do that. And when the returns do come in, then again it's a staggered out. So staggered in and staggered out is the approach, right? So our entire goal is to build versatile portfolios that prosper in all markets. So if you see, for example, when you have a high inflation, high interest rate scenario, fixed income outperforms. Usually that's the case. This time it has not taken place that way. High growth and earnings relating, usually your equity outperforms. But in a scenario where you're staring at a slowdown and you require a more dynamic strategy on taking advantage of equity as an asset class, debt as an asset class, uh, precious metals as an asset class, global as an asset class, you hear your multi-asset goes out and outperforms. So our entire endeavor is to make sure that the portfolios that we're building are versatile enough and prosper in all markets. So how has it performed in all markets? If you see from a long-term basis, this is since inception, but I would say that return expectations should somewhere be between your inflation plus 5 to 7%. But if you see since our inception and how this strategy has been working, we've been able to deliver very well by outperforming your equity and your other multi-asset funds as well, along with your dynamic asset allocation category. Right. So for a flexi cap, we're able to do very well. For also in terms of the category for multi-asset, we're still able to do well. Though early days, I would say, but in terms of drawdowns, our drawdowns have been since inception. Our drawdowns have been 4%. Right. And multi-asset, the index has been 5 and Nifty has been 10. This is drawdowns, right? So this number again would get updated in the next month, which is that the number will get published in this month, considering January to come in, and then you'll see further on how our strategy is actually going and performing. So if you see the performance numbers for 31st December, we have uh, since inception, our CAGR has been somewhere around 25%. But what I want you to see, this is too early for you to judge. But what I would say is that the strategy has been doing very well in terms of managing volatility as well as delivering returns at a lower risk, since we have around 16-17% into precious metals. This is from a house perspective, and equities are 75%. So if somebody does onboard today, say, yes, I want to, put money into this strategy, that doesn't mean that 75% would go into equity. No, like I said, it takes time. We do take our time to stagger in and build positions on the equity side, on the precious metal side. So priorities would be based on fundamentals and based on valuations. And hence, this number is only for you to look at more from a broader perspective, not from a, okay, this is my portfolio that's going to be. Every portfolio that we build is different. It's based on particular needs, it's based on particular goals. Right. So if somebody is able to participate more into ideas or newer ideas and existing ideas that we want to participate into, then you will have their portfolio look completely different than your portfolio. Right. So participation level matters a lot. It's just like a mutual fund, but here you're able to participate directly into themes, into asset categories. Whereas for a mutual fund, you will only get the NAV, right? It doesn't. You just get the NAV and the movement of the NAV. Here, you're a direct owner of that particular ETF or that particular stock, right? But here we build slowly and it's staggered in and staggered out, right? That's what I would say. Who is this meant for? This is meant for somebody who has a risk appetite of between conservative to moderate. Since it's a dynamic sort of a strategy, here this we do operate between this particular space. For somebody who's extremely conservative, we have another strategy which is more large cap oriented. So this comes in between that of a flexi cap strategy and that of a large cap strategy, which is run conservatively. But this is not one size fit all. Everything here is extremely tailor made, right? But if somebody does have that risk appetite of between moderate and conservative, this is that strategy for you. Your return expectation should be inflation plus 5 to 7 odd %, right? It's a very realistic number that we are projecting. This has nothing to do with what we have delivered, but going forward, our entire endeavor in this strategy itself, we've been able to do somewhere between average inflation to 5 and 7% plus. Right. Minimum investment is 50 lakhs. Here it's a fixed fee strategy. It is only it's 1.5% per annum. So it's very competitive to that of your direct mutual fund. And it is compounded, it's computed on daily average portfolio value, which is charged quarterly. Right. So all the dividends are yours. Right. So you don't have to pay us anything. It'll straight away come from within the portfolio. Right. Something about the team. So we have 4 fund managers and Shamsa is the CIO and the fund manager of this particular strategy as well. We have a strong roster of research and strategy. And we have Balaji sir, who is the head of research, and he's the co-fund manager of the large cap strategy. You have Rohit and Rajat, who are managing the small cap strategy, and you have Niranjan sir, who is part of the Neo and the Sphere strategy as well. Right. So now I'll open the floor for Q&A. If you want me to go through any particular slide, I'm very happy to go through. But this is a product that is only meant for non-resident Indians and not resident Indians. If you're a resident Indian, there is an Indian strategy which is Sphere, which is very similar to this. The only drawback is that this one would not have mutual funds because of compliance and regulatory. That one would have. Okay, there's a question on in the wake of today's budget, which will benefit middle class, which are the sectors that will benefit. It's too early. I've been in and out of meetings and all of this. I'm yet to get a broader sense of how things are. But going by the notifications that have been coming on the phone, it looks like it is you'll have more disposable income. But I think that you can wait for our official communication that comes out. For Middle East, you can opt for Neo. Neo is for non-resident Indians. Difference between a bottom up and a top down. See, top down is more from a macro oriented perspective, where you don't see, where even if the debt levels are high, you still say that, okay, this particular category has a lot of government push that's coming place. So it's more like a sort of a opportunistic turnaround sort of thing. And bottom up does take consideration of fundamentals and seeing, what the quality of the business is and, what the quality of the balance sheet is and whether it warrants such a high valuation. So it has to always be a mix of both. Any hidden charges, that 1.5%, for example, if some stocks perform very well, no, there's no profit sharing. The only added charge would sort of be your custodian charges and your opening charges and all of that, and your GST. So apart from that, as we don't have a profit sharing model at all. Okay, why Neo is not able to do MF? See, we since it's non-resident Indians, the regulatory requirement and the tax requirements are very different, right? So the disclosure for mutual fund and ETF are quite strenuous for investors in the US and Canada. So hence we said, okay, if then the option comes up, we do have that option. It's just that, we are not choosing to do it. How do you effectively use forward P ratio? Uh, See, forward P is basically your earnings that you project for the next couple of years, and you say, okay, today the price is this. I'm going to earn. I mean, the company is going to earn this much on a bottom line basis for the next couple of years. So, given that today the price looks either expensive or either cheap, that is based on the company. Difference between Sphere and Neo. Sphere is for Indian residents, and Neo is for non-resident Indians. Is because the taxation and the regulatory part is different. We wanted to split it. Okay, what will be the sector allocation and how often will it churn from one another? See, our churn ratio since 2022, since our inception, is somewhere around 34 or 35%, which is very low. So we don't usually churn unless and until either either the idea has played out or the idea has become extremely expensive for us to even hold. So from that perspective, uh, you will not see a lot of change unless and until these are the two reasons. And the churn ratio since inception is about 34%, 35%. As broadly, forward P ratio can be between mid-teens to mid-20s as app. No, it depends on the business. It depends on the company. It's not the number. The number does not highlight anything. It's based on the company's history. It's based on the industry. There are a lot of factors to consider. It's not just a number. And that level of I don't think that that level of work you should put into to understand, because it you need to spend a lot of time in the market to understand how an industry has evolved, an industry has grown for you to actually assign a particular multiple. So internally we say that if you have at least 5 hours in a day to spend on equity research, unless and until you have 5 hours, then you should not do direct stock, or you should not do all of that. You should always work with a professional. Very good question. This portfolio is fully controlled by you or the investor. Is the investor allowed to do something? No, this is a completely discretionary PMS. So you are not allowed to do anything in this. It's a completely discretionary PMS. What is the CAGR for solitaire and sphere? Hold on. Let me just share the number so that you're aware. So as of 31st December, your solitaire CAGR since its inception, the inception is 30th August 2019, is about 25.97%. For Sphere, which is our Indian your resident multi-asset strategy, is 22.07%. And that inception is 2021. But I would say that don't fall for the you always look at it from what our commentary is. Our commentary is that no, we would like to grow only between average plus 5 to 7%. That is sustainable, that is stable, that gives you a very good experience, and you can clearly make enough wealth. For NRE, do we need to open a PAS account? Yeah, depends on what account you have. So so we can take that one-on-one. Just send us a hi on this number, and our team will get in touch with you. But yes, it depends on which bank. If it's the same banker, then you don't need to. Then we'll have to see. So it's a very case specific basis. Just send us a hi on this number. Yeah, solitaire is allowed for NRI. Yeah, you can do, because that is a 100% equity portfolio, no? That you will not have a problem. For a multi-asset, we had to split. Okay, since I'm an investor, I would like to ask a question. How the money is protected if your company is shut or not able to contact, etc.? Because it's happening nowadays. Please clear this fairness. See, we as an organization, we have been in existence since 2012, 2013. So it's been a long time since we uh, have been in existence, and everything is in your name. This has nothing to do with us. We are just managing your money. Nothing is in our name. So whatever businesses we buy, it's all going to be in your name. So it's your bank account. We are doing all of that for you. It's going to be in that particular bank account. If you check your NHDL, it will be in your name. So I do agree that this is a big risk when it comes to other businesses and what's been happening in the market. But here we have kept clear checks. Nothing is in our name, so everything is going to be in your name. And you have access to the exchange, and you can do whatever you want to do, once if at all the event does come in. But here we make you sign agreements, and that we are the manager, and it's a discretionary PMS, and you can't do anything. But in the event, everything is in your name anyways. All the gains are yours, everything is yours. Is small and mid cap count to real valuation or still high valuation? There are parts that are still very expensive on small and mids. Exit from small and mid. See, we have been talking very vocally about how high the valuations are for small and mids, and uh, when we are also investing on the small and mid cap side, we are very cognizant on which businesses we want to buy. When you're having a more basket approach towards investing in small and mids, then if the entire basket is expensive, then your risk of capital getting lost is high. So we are very cautious when it comes to small and mids. For intrinsic value of a business is all about evaluation or whole business outlook. See, in intrinsic value of a business is very, very broad based. It comes with a lot of experience. It comes with understanding how, like I said, how the industry has evolved. It's like seeing your child grow up. you would have seen them when they were 10 years old, and by the time they are 20, they are a completely different person. And after 20, when you see them at 30, they are a completely different person. They evolve, they get better. And who they serve also keep changing over time. It's a very dynamic thing. So it's a very broad-based concept if you have to see from, just to understand what the intrinsic value of a particular business is. Right. So we look at intrinsic value from a point of, can this, business be there for an extremely long period of time? Is it going to go away? Is it somewhat easy to say that yes, the cash flow is going to grow at a moderate rate, given who they serve, given what the product is, given what the service is, right? So there's not a lot of earnings volatility when it comes to such businesses, such industries, and hence naturally their the value of that business will be high. Many people are afraid to invest in a PMS for this reason. Yes, I 100% agree. Please don't apologize. But yes, that is a case. See, when more market participants come in, when more services are being offered, definitely that risk is there for who you partner with. Right? And from a team, we are growing in size, and but we've made sure that there are agreements and checks in place, and everything is whatever we do is everything is in your name. We are just managing it for you. PMS tax implication is high. MF definitely is better in terms of tax if you compare MF versus PMS, because there here when you have a because when you have a multi-asset approach, then you're taxed on different asset classes. But whereas MF is it's slightly tax efficient than that of a PMS when it comes to multi-asset or a dynamic sort of a category. Otherwise, equity is the same. And your work with the auditor is higher. One fund manager looking at how many portfolios in PMS, any limitation? No. At I thought here everything is a team. So there is a team that manages the Sorta portfolio where Shamsa is the fund manager. There's a team for small cap, there's a team for large cap, and there's a team for multi-asset. So everything here is team based. Other than that, there's no limitation. How to correlate macros and investment decisions. Spend some time, understand how things are. Only then you will be able to understand how to correlate. First, I would say if you're just beginning off, then spend some time. No, we don't have any auditing service. We can provide you all the details in terms of your capital gains and all that, but ultimately it's who you have to sit with your auditor. Yeah, what about insurance services? Yes, we do provide insurance services. So we have a separate team that looks over insurance. You just send us a hi saying I have an insurance requirement, and the insurance team itself will get in touch with you. Yeah, all types of insurance. Yeah. So whatever is the requirement, we will understand whether you're underinsured or overinsured. We'll take one more question and then we can close. If there are any further questions that you have that want to be addressed, please just send us a hi, just send us your query, and team will get in touch with you. Is this good for retired people? Uh, See, I would say that first we would like to understand what your condition is in terms of what would your monthly asks be. So once you retire, there's a certain corpus and you would need something on a monthly basis to live off that entire corpus. I think this is a case specific question where we'll have to sit with you to understand what your requirements are and only then see whether this is a product that can suit you or not. Yeah. Okay. Investment evolution is putting in the hours. Yeah, you have to spend a lot of time. It's a learning every time, every cycle, and it's time in the market that actually helps you in understanding a lot of things, not timing the market. All right, then thank you all so much for joining in. Have a great weekend ahead. I'll see you all next week. Thank you so much.